let's talk about trading the 7DTE process. Let's talk about the criteria that we're going to look for and why it can be a really successful type of trade because it's less risky than anything less than 7 days, but it can still be that good kind of medium between a longer term trade and a shorter term trade. And it can help you be able to make some short term gains and still be able to adjust if things go poorly. So when we are looking for a 7DT trade, we are going to set it up based on the implied volatility, the expected move that's being created from that implied volatility, and what the straddle price is, and then just by deltas, trying to go no higher than a 10 delta on both sides, but ideally something lower than a 10 delta, and ideally at least two times the expected move. But if but that's ideal. So sometimes it's going to be 1.5 times the expected move to be able to get the type of premium you're looking for. You're trying to get at least $1 for this type of trade, and you can do that from a 10-point wide spread. You can do that from a 15 or 20 all the way up to a 50-point wide spread, similar to how we would execute sometime a 0 DTE trade up to 50 points wide. It all depends on your account size, but you want to do this trade with as small as possible so you can have ammunition to be able to adjust this trade. So for example purposes, let's say you started off with 10K, $10,000, and you just use this 7 day strategy. And let's say the first trade you initiated was a 10-point wide spread, which would equal the max before the premium received is $1,000 loss. Okay, that's $1,000 or $1,000 you would have to put up. Right, your max loss will be 1,000 before the premium received. That's how much money you're gonna have to put up for buying power. So if you did that, if you would be able to still have $9,000 left to be able to deal with things. So if you had to adjust and add another contract, you can do that. If you had to adjust and make the width of the spread wider, you can do that. You have a lot of ammunition to be able to move your trade away from the at the money further to increase your probability. So if you initiated a trade with an 80% chance of winning, as you say, and then you had to make an adjustment, and you can make that adjustment and keep your probability with that new trade, that new adjustment around the 80% again, that's increasing your odds. That is definitely significantly increasing your odds of being able to win because of that adjustment. But as I say, for some particular reason you had to adjust again, and you were able to stay around that 80% mark again. So the odds on you're going to be able to lose after three adjustments like this with 80+% chance of winning each time are very, very small. Nothing's 0% chance of losing, but it's going to be somewhere in that range of only maybe a 3% chance of losing on the trade. And so this is in my opinion, a really powerful way to be able to adjust this if you're doing it really small. We kind of demonstrated this last week when we did a 7 DTE trade. It went wrong with the market jumping up significantly. We were able to adjust it from a 10-point wide spread to a 20-point wide spread to staying with the 20-point wide, but adding another contract. So making it from one contract to two contracts, and we were able to win on that trade yesterday, which was very nice.
Please subscribe to our channel. Have fun trading!
So what we were discussing is just being able to adjust and being able to, when you adjust, to be able to keep your probability high. And you can only do that if you're trading this at a very small amount of your account. But that's fine. This stuff will add up, meaning that if you if you had a $10,000 account and you made, let's say out of 4 weeks, you did this, once a week or whatever the case may be, and let's say you're able to get $400. Well, that's 400. That's 4% of your 10,000. Right? That's 4% of your 10,000, which is an awesome return if you are compounding it over a year, or if you're not compounded. It's still a really, really phenomenal type of return if you can do that just using your 10K account. Okay? And then let's say you got half of that, 2%, that's still really good. So, and that's putting on a 7 DTE trade or something very close to that, basically once a week. Sometime, obviously, you're gonna have to make an adjustment, and that week trade is gonna turn into 2 week trade, perhaps. But that's fine. You're gonna go through periods where you have no problem. You can go through a whole month or 2 or 3 where you just bring in the register every time you put on the trade, and then you're gonna go to some periods where it's extended, right? The trade's just not gonna work out for a little while, and that's fine. That's trading. So when you're doing this, what you want to do is, once again, look at the expected move first. right? So this expected move is, I just say 55 on the TastyTrade platform. So we say 55 times 2, that's 110. And so we want, that's 110. I like to look at the straddle price and see which one is more. So this is basically the same, but that's running at the 56 times 2. This is a 112. So I'm going to go with the 112. You can go with the TastyTrade or the Thinkorswim platform or your platform expected move.
Ryan, can I ask a question?
Yes.
Can you go back to the straddle and tell me what is it that you're looking at the straddle?
So on the straddle price, I'm just buying the straddle or selling it, but I'm buying it, and that's giving me the price of what the straddle price is. So
Oh, so
um,
it's the 55.80 that you're looking at.
exactly, that's what I'm
Okay.
looking at. And
I
so
see
I
the high.
usually like to take that higher number.
Okay.
TastyTrade believes that their calculation is closer to the one standard deviation or the 68% of the time, and it's better than the straddle price. And I just say it is right, but I still prefer to have the bigger expected move if I can have it. Doesn't mean I can, but if I can get it, then that's what I'm going to go for. So in this example, if we said it's 112, I would take this number here and I would subtract 112 for instance. So 4368 minus 112, that'd take me to 4256. That's giving me 4256 is basically around here. And as I say, we started off with a 10-point wide spread. That's giving me $45, and that's about a 7 delta. And so then I would take that 112 and add it to the 43, as I say 4368. That's what we were at, right? So I'm gonna take the 112 plus 4368. That's gonna take me to the 4480. So if I went to the 4480, that's also around a 7 delta. And if I did a 10-point wide, you can see that this is giving me $90 to $95. Well, this is not the $100 that I want in this trade. And I'm going to be a stickler about this 7DTE trade is that I want $100 at least. And that's after fees and commissions because it has to be worth it for me, right? It has to be worth it for me. I'm trying to make I'm trying to be able to make a decent income off this, or a decent amount off this. So if I'm going to get 50 to 70% of that $100 after fees and commissions, then great, right? So let's say I'm only getting 50%. Well, that's still going to give me a 2% return, perhaps, if not more, on in a month. If I can get closer to that 100%, or excuse me, closer to that 70%, then that's going to give me a bigger return. A lot of times you're going to be able to collect a lot more than $100, okay, and still get that 50 to 70% return on your capital or profit percentage on that capital. So in this example, we are 2 times the expected move, and we're at a 7 delta. We said we would be okay with going as high as a 10 delta, but ideally the lower the delta, the better. So in this example, you have to decide which side do you want. If you're only going to do a 10-point wide spread, obviously if you were going to do something that's wider, then you would be able to meet your criteria at this point. So for example, let's say I was going to do 15-point wide. Well, that's already 110 now. If I was going to do a 15-point wide on this side, I would even it out. That's 120. So that's going to give me my $100 after fees and commissions. If I did a 20-point wide, you can see that that's going to give me 135. And if I did the 20-point wide on this side, well, now I'm getting 155. So perfect, right? I got 155, and if I got this, so 155 times 70% of that, that's going to be 108. Right? If we got 70% of that 155, even if it was 150 or whatever case it be at the fees and commissions, we still got our $100 there. If we wanted to do a 20-point wide spread. So, but if you wanted to stick with the 10-point wide spread initially, right? And so then you have to move one of these sides up perhaps. So this is a 10-point wide there. So, and let's move this put side back to a 10-point wide. So that's 120 there, right? The put side, the call side is a 10 delta, the put side is a 6 delta, and we're getting 115 to 120 there. So if we decided, okay, well, let's move up this put side a little bit more, and let's say we decided we're going to go to a 9 delta on this put side. Well, now we're getting 135, 140 on this trade, which is not bad at all. The market has kind of come back a little bit here. All right, so going back to this trade here, we can collect about 130 here. And so if I decide that I want to do this trade, then great, right? I can do this and try to get filled, and then this will be my 7-day DTE trade. Now, but what's going to happen is if this trade becomes, let's say on the put side, it goes from a 9 delta to a 31, what we call the beginning of the red zone. Then at that point, I'm going to decide to make my adjustment. And my adjustment, let's say it did this, we started with 7 days. Let's say it did this tomorrow. The market just super dropped, right? And it was 6 days to go. Well, I most likely will not roll this out at that point. I'm probably going to do some type of roll away, and roll away is moving from away from at the money. So I'm going to move the spread in this direction, right? Away from at the money. And then I'm going to roll up this spread, because if that one became a 31, this is probably going to be a 1 or 0 delta, right? If that happened that way. So I'm going to move that up to be able to pay for this move over here. And if I wanted to increase the probabilities, what I can do is is add another contract, right? Keep in mind, I have 10, in this example, I have 10K. I've only used 1K of that $10,000 to put this trade on. So if I had to move this, let's say from a 31 back to a, let's say a 15 delta, for example purposes, then I can do that and add another contract or make the spread wider to be able to do it for a credit. And yes, if I add a contract or make the spread wider, I'm increasing my max potential loss, but I'm also increasing my probability of success. So it's trade-offs. I rather increase my probability of success and instead of trying to keep my max loss the same. I'm all about probability of success. Okay? So for example purposes, if you were doing a naked call or a naked put or a strangle, then you it's your max risk is going to be a lot, right? You have risk all the way to zero on the put side, and you have theoretically unlimited risk to the upside. Well, you're not basing your loss on already zero, or you're not basing your loss based on possible infinity to the upside, right? You're basing your loss on a certain level of delta or dollar amount of that strangle. And that's the same kind of concept with this. I'm still focused on that short leg and keep thinking about probabilities of success than max losses. Okay? And so that's how I would adjust this trade to be able to make the probabilities better. Okay? All right. So what I mean by the tested side, everyone, the tested side is the side that's causing you a problem, the side with the higher delta. So if the market was going down, then the put side would be the tested side. The call side would be the non-tested side. Okay? So this is the problem, the side you're worrying about. This is the side that you can use to kind of help offset this problem side. Okay? This problem side, and vice versa. Right? The call side can obviously be the tested side, and the put side could be the non-tested side. All right, so let's jump back over here and let's now execute the trade. Okay, let's execute the trade. And I'm gonna execute this trade inside of this Thinkorswim account. Okay, we're gonna go over here to the SPX 4460. All right, so still a decent amount away, and we're gonna do a 10-point wide there. And it's like, man, that's something that's off there. There's no way that should be that amount. Anyway, so then we're gonna go over here to this 10 delta here, and we're going to do a 10-point wide. And so the short strike on the call side is the 4460. The short strike on the put side is the 4275, and that's giving us about 150 to 140. So we're gonna send that at 145, and let's see if we can get this filled. And we just got filled at 145. So that is a 7DTE trade. We will make an adjustment once one of the sides hits the red zone. Okay, and once it hits the red zone starts at 31 for the Dorian way. Okay, 31. And that would allow me to let things play out to some degree, and then allow me to be able to adjust before things get out of hand. Okay, so we only used $1,000 to be able to do this trade before fees and commissions, or excuse me, before the premium, and so we actually used a little less than that to be able to do this trade, and we collected 145.